All right, let's dive in. I want you to imagine something. It's 2026, and all the hype, all the incredible stories we've been hearing about the future, they're finally getting a reality check. We're breaking down an analysis that calls this year the Great Evaluation. That moment when the narrative has to square up with the hard numbers. Let's get right into it.
So, this analysis, it doesn't ease you in. It drops us right into the thick of it on a very specific date, February 5th, 2026. This isn't some far-off prediction. No, the markets are a sea of red, and you can just feel that we are on the edge of something huge. The source material frames this as what is happening right now. And to really hammer home the gravity of this moment, the analysis uses this incredibly powerful quote. It's framing today not as just another bad day on the stock market, but as a genuine crossroads, a turning point unlike anything we've seen in a century. The stakes? Well, they couldn't be higher.
So, how in the world do we make sense of all this? Here's our game plan. First, we're going to understand why this is such a major inflection point. Then, we'll look at the whole situation through 5 different analytical lenses. After that, we'll zoom in on the main event, AI, before taking a tour of the very shaky global markets. And we'll wrap it all up with a look at what the report calls the defensive playbook. Okay, first things first, what makes February 5th, 2026 so important? The analysis says it's basically a perfect storm. You've got this rare combination of disruptive tech, incredibly volatile politics, and super fragile financial markets all colliding at the exact same time. And this slide, wow, it just paints the picture of the chaos perfectly. The Kospi is down almost 4%. Silver had a shocking 17% crash in a single day, and Bitcoin is stumbling. But here's the key. These numbers aren't happening in a vacuum. President Trump is launching his new Trump RX plan, and the fallout from the Epstein scandal is reaching the highest levels of power. This is the shaky ground we're standing on. So, how do we begin to get a handle on this? Well, the report offers us a framework. Instead of just throwing a bunch of facts at us, it gives us 5 powerful ideas. Think of them as 5 different lenses to bring all of this chaos into focus. Let's walk through them. The first lens is Gunter Duke's concept of swarm stupidity. Now, I know it sounds a little harsh, but it's a brilliant idea. It basically says that a group, even one full of geniuses, can collectively make a really, really bad decision. The analysis points its finger directly at the AI sector. You've got every tech giant frantically spending billions on infrastructure, terrified of getting left behind. It looks less like a smart strategy and a lot more like a panic-driven stampede. Next up, time preference, an idea from Saifuddin Ammous. It's pretty simple. When the future feels really uncertain, people want rewards now, not later. This leads to all sorts of short-term speculation instead of patient, long-term investing. The report says this is exactly why we're seeing these wild swings in things like silver and crypto. Investors are chasing a quick buck because they've kind of lost faith in the long run. Our third lens is a classic from Ken Fisher, the price-to-sales ratio, or PSR. Think of it as a way to gut check if a stock is just way too expensive. And here's the flashing red light. According to this analysis, the PSR for today's big AI tech stocks looks almost identical to the charts right before the dot-com bubble popped back in 2000. That is some serious historical déjà vu. Then we have socionomics. Now, this theory totally flips conventional wisdom on its head. It says it's not the events that shape our mood, it's our collective social mood that shapes the events. When the public mood is negative, scandals that might have been brushed aside suddenly explode. The report connects the escalating Epstein scandal directly to this pervasive negative mood, which is making markets fragile and investors super pessimistic. And finally, the analysis zooms way, way out to the 54-year wave. This is a long-term cycle theory that says major economic peaks and valleys happen roughly every 54 years. Well, if you start the clock from the last major downturn, the stagflation of the 1970s, that puts us right at the beginning of the next big one. It frames 2026 not as some random blip, but as a predictable turn in a cycle that's been going for decades. So you put all those lenses together, and they all bring one thing into sharp focus: the AI market. This is where the story of unlimited potential is about to have a head-on collision with the reality of a very nervous market. This right here is the main event for 2026. Which brings us to the absolute core question of this entire analysis. The AI boom. Is it a sustainable revolution that's going to change everything? Or is it just a massive bubble, pumped full of hype and now teetering on the brink of popping? The report boils it down to this fundamental conflict. On one side, you've got the narrative that's been driving the market for years, just unlimited growth, spend whatever it takes. But on the other side, reality is starting to knock on the door. There's this urgent demand to see a return on all that investment. The question isn't how much can you spend anymore. Now it's what profit are you actually making? So the report's verdict? It's not a total wipeout. Instead, it's predicting what it calls a selective collapse. By the end of 2026, the forecast is that fear is going to overtake optimism. The market is going to pivot hard from rewarding growth at all costs to demanding real, tangible profits. And this is going to cause a huge split, separating the hardware makers from the software companies that are struggling to turn all that fancy hardware into actual cash. Okay, with that AI forecast as our anchor, let's take a quick tour around the world and look at the specific, number-driven predictions this report makes for the major markets through the rest of the year. For the US, the outlook is, let's just say, cautious. The report sees the S&P 500 being pretty weak, held back by a tough Fed and a cooling job market. The Nasdaq is expected to take a bigger hit as those AI valuations get their reality check. But what's really interesting is that it sees bond yields falling by the end of the year, as fears of a recession push investors to run for the safety of government debt. Hopping across the Atlantic, the story is really all about politics. The report expects a weak UK market, and it connects that directly to a leadership crisis and that negative social mood we talked about with socionomics. For Germany, the trouble is coming from outside, China's slowdown and trade tensions, and the euro is expected to get weaker against the dollar, maybe even getting close to parity, just because of stagnant growth. Now let's shift over to Asia, where the analysis has a pretty nuanced take on China. Yeah, the Hong Kong stock market might bounce back a little, but it's going to be held in check by the ongoing tensions with the U.S. The real story, according to this report, is China's strategic control over rare earth minerals. It's predicting a strong bull market for these resources as China basically weaponizes its supply chain to deal with its own economic problems at home. For South Korea, the report is pretty pessimistic, forecasting the Kospi could retest its lows. It points to a deepening Korea discount. That's the idea that Korean stocks just trade for cheaper than their global peers, and says it's being made worse by new regulations. The Korean won is also expected to stay weak against the dollar thanks to sluggish exports and that big interest rate gap with the US. Okay, so after that pretty sobering tour of the global markets, the report doesn't just leave us hanging. It actually wraps up with a strategy. How are you supposed to navigate this great evaluation? And the main takeaway is delivered loud and clear. The era of just buying into a good story and believing in growth at any cost, it's over. According to this analysis, the market is sending a signal you just can't ignore. It is time to play defense. The report lays out a really simple 3-step playbook. First, build a defensive portfolio. That means shifting away from speculative tech and towards stable, essential industries. Second, raise your cash levels. In a market like this, cash isn't just about safety, it's about opportunity. It lets you make moves when everyone else is forced to sell. And third, be ruthless about focusing on assets that have real, intrinsic value and a clear, predictable cash flow. Because in this new world, the story isn't enough anymore. The numbers have to add up. And all of that brings us to the final, really thought-provoking question that this analysis leaves us with. As the tide of hype goes out, we're all forced to ask ourselves this. In an era where everything is being reevaluated, what truly holds value? And that, it seems, is the defining question for the rest of 2026.